Today, I want to talk about how Citadel Securities is just about to go bankrupt and how there will be massive liquidations coming. Right now, Citadel's entire business model doesn't make sense, so I want to explain how it's rumoured that Ken Griffin is hiding its losses and how he will be liquidated. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So the question is Ken Griffin admitting that he can't survive 2023 by posting incredible 2022 returns? This user says, when coming to this conclusion, I factored in 4 things. Citadel makes a commission from their returns and probably gets temporarily locked out from making commissions if losses start appearing. Many hedge funds make, say, a 2 and 20 return, aka they take 2% of their clients' assets every single year as management fees and 20% of all of their profits generated. Therefore, if Citadel isn't generating any profits, they don't get to keep any money. And if they start making losses, they may have to make profits in the future and break even before they can actually start taking their clients' profits. Therefore, Ken Griffin is seemingly hiding his losses and just showing returns for his clients, so Citadel keeps that 20%. But maybe Citadel's clients are already aware of these losses, and that's why Citadel is limiting the client withdrawals. Their clients have already withdrawn the maximum they could, and Kenny knew that in advance, and that's why he limited the withdrawals and why he's now trying to hide the losses. He said as a market maker or short hedge fund, their returns are mostly unrealised and can be adjusted by adjusting liabilities, aka they can recognise their gains and leave their losses as unrecognised. The losses have still occurred, but because they haven't closed out of the trade, they haven't recognised the losses and they haven't reported them. And he added saying their GameStop and AMC short positions are likely profitable right now, and they can increase their unrealised returns by shorting it more, but they can never truly close out of that position and recognise those gains and survive. Obviously, if Citadel tried closing out of their short positions, it would cause the GameStop and AMC squeezes, and their entire hedge fund would be liquidated. Therefore, they're holding on to those unrealised losses, they're holding on to their unrealised AMC and GameStop gains, and only realising some of their profits to show to clients while holding back that wave of losses. And this user said if you were faced with these factors and wanted to run your fund for as long as possible into the future, you'd post near 0% returns, which would hurt your commissions and the amounts you could keep from your clients, but you'd also limit client withdrawals. But he said if you knew this year would be your last and that you couldn't close out of tons of your positions without bankrupting the entire fund, you'd try and get as much money from your clients while you still can. By showing massively overinflated profits, Citadel can keep 20% of those profits and only return the remaining 80% to their clients. But obviously if Citadel is keeping 20% of nothing is still nothing. Therefore Citadel showed a massively overinflated return figure to keep as much money as possible. And another user also added saying, I read all of these posts and most seem to be devoid of the fact that Citadel Securities, the market maker, is a separate business from Citadel LLC, the hedge fund. He said, what I find most interesting is that the investment side supposedly only has 19 clients. The Citadel hedge fund apparently only has 19 investors. He said it's like a slap in the face that the market making function is undoubtedly used to prop up the investment hedge fund. And he said on top of that, surely nobody at this point would be surprised to learn that the market making side has also been porting cash over to the hedge fund side. He said, particularly given the recent FTX developments and how FTX was sharing money from FTX to Alameda Research, he would definitely say it's a massive possibility that this is also occurring in Citadel. He said there's no way Sam Bankman-Fried and his little cabal were able to orchestrate such a mess without governance and direction. For example, we know that tokenized shares likely only existed, so these market makers were able to bury their synthetic shorts with false locates. And it's also the exact same way that Bernie Madoff was running his business as well, basically operating through his market making business and hiding everything else through the hedge fund. And Adam added saying, remember how Bernie Madoff ramped up his fake money printer in the last few years of his fraud? Well, it seems Ken Griffin is doing the same thing. As Pip and Sammy tweeted, he said, doesn't it seem odd that Citadel is reporting record profits while Tiger Global, Blackrock, Credit Suisse, UBS, National Bank of Switzerland, Goldman Sachs, Wells Fargo and many others are losing their shares? Goldman Sachs just posted their worst return in over 10 years. The National Bank of Switzerland just lost more money than it's ever lost on record, over $100 billion. Credit Suisse almost got liquidated this year and almost went bankrupt. Blackrock has lost $1.7 trillion and Tiger Global is down over 50%. But yet Citadel Securities is somehow smarter than all of these other larger hedge funds and major banks and has been making 30+% returns. I saw a tweet a little while ago, but I can't find it, but it was basically saying that Citadel has been recognising some of their gains and hiding all of their losses in those $65 billion of securities sold and not yet purchased. Instead of recognising the true figure, which is likely a 20, 30, 40 or 50% loss, Citadel has hidden those losses in the securities sold not yet purchased and just recognised some of their smaller profits. It seems practically impossible that some of the largest hedge funds and major banks in the entire world were simply not smart enough to somehow outsmart Citadel. And this is all coming at a time where Bed Bath & Beyond, GameStop and AMC are all starting the next run-up. We've seen over the last week Bed Bath & Beyond has been running up massively, and you may have also seen this FUD article recently released to try and take the heat away from BBY. Tenny Barron tweeted saying allegedly Ryan Cohen has bought a stake last year in Alibaba, according to the Wall Street Journal. But as Tenny Barron tweeted, he said, why would they post the article now? They clearly held on to it to post it just before the biggest option ramp is about to go off on Bed Bath & Beyond. On top of that, he said the Wall Street Journal has been wrong before about Ryan Cohen not purchasing stocks that he was supposedly purchasing. What's to say this time they're actually correct? Clearly the mainstream media is just trying to distract from Bed Bath & Beyond, GameStop and AMC and push our interests elsewhere, like over to Alibaba. And as Jimmy Short Squeeze tweeted, he said, before you go balls deep into Alibaba, remember that Alibaba is a market cap for the big boys and a highly geopolitical stock. He said, I highly doubt apes alone can significantly influence the Alibaba price and potentially causing a barber short squeeze. On top of that, it's worth remembering that Citadel Securities actually holds a massive position in Alibaba, so clearly the mainstream media is just trying to get us to pump up Citadel's bags. We'd effectively be generating liquidity for Citadel as they hold a massive portion of Alibaba, potentially allowing them to escape the short squeeze caused and triggered by Bed Bath & Beyond. Therefore, by not buying shares in Barber, we will not be generating liquidity for Citadel and they will struggle more and more and more. Especially considering that Citadel is likely hiding tons and tons of losses, as they seem to be the only hedge fund this year that generated a profit. But this giant Bed Bath & Beyond options ramp is also happening at a very interesting time with the S&P 500. Mr. Derivatives tweeted saying the last 3 times the VIX had 4 consecutive days below 20 points was August, April and January of 2022. He said each time the markets topped, that led to a 19%, 21% and 14% decline respectively. And he said we're going for the 4th consecutive day below the 20-point VIX area today. Mr. Derivatives is basically saying the S&P 500 is likely to U-turn over the next few weeks, potentially falling to new lows. It seems the bear market rally is just about finishing as we're below this area on the VIX and there's tons and tons of stocks above their 50-day moving average. This suggests the next leg of the market crash is just around the corner and is just about to start, likely over the next week or two. Obviously, as the market continues to crash and crashes further to new lows, it will mean that more hedge funds are on the brink of being liquidated and margin called. And even JP Morgan is supporting that theory by saying to take profits on this rally, on this bear market rally, as it will start to fade in the first quarter, literally over the next few weeks. Even JP Morgan is saying that it is a bear market rally and the S&P 500 will be falling further over the next few weeks to new lows, meaning that tons of hedge funds will go bankrupt. And this also seems to be happening at a very interesting time when the Department of Justice is now offering a 75% reduction in fines to companies that admit their crimes. This seems like an excellent way to pull Citadel from their illegal crimes by asking them to admit to their crimes and to admit how they were committing the crimes for a 75% reduction in punishments. Even though I would like to see Citadel and many other hedge funds and market makers receiving full punishment for their crimes, at least this would bait them out into the open, causing the short squeeze. It says the Justice Department will recommend as much as a 75% reduction in fines for companies that voluntarily report wrongdoing to the government and fully cooperate with investigations. And even companies that don't voluntarily disclose wrongdoing but still fully cooperate with investigations could still get a 50% reduction off the low end of the guideline for fines. It says the policy is sending an undeniable message: come forward, cooperate and remediate. And an attorney general said we're going to closely be monitoring and examining how companies discipline bad actors and reward the good ones. Hopefully this encourages more whistleblowers to come forward and encourages companies themselves to admit their wrongdoing and admit their illegal crimes for a reduction in punishment. Obviously, if Citadel or any of the other hedge funds or market makers that are manipulating AMC and GameStop come forward, yes, they will receive a smaller punishment or a reduced punishment, but it will bait them out into the open and it will cause the squeeze. Obviously, as part of that punishment, they will be forced to close out of all of the synthetic shares created, buying back hundreds of millions, if not billions of AMC shares, obviously causing the squeeze. But guys, be sure to let me know what you think down in the comments below. And as always, guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.